The biggest financial risk facing your portfolio isn't artificial intelligence hype, trade wars, or whoever's sitting in the White House. It's something so boring that most investors have never heard of it. And that's precisely the problem. If you've been confused about why mortgage rates won't budge despite Federal Reserve rate cuts, or why markets seem jittery without obvious cause, the explanation doesn't begin in Washington, it begins in Tokyo. More specifically, with Japanese government bonds, the single most mundane asset class on planet Earth. Yet this sleepy corner of global finance has been the invisible scaffolding supporting markets worldwide for 3 decades. And right now, that scaffolding is buckling. To understand what's happening, you need to go back to 1992. That year, Japan's massive asset bubble finally burst. Real estate values cratered. Stock prices collapsed. The economy didn't just slow down, it essentially froze. What followed became known as the Lost Decades, a 30-year stretch of economic stagnation unlike anything the developed world had witnessed. Zero growth, zero inflation. Wages stayed flat. The entire system hit pause and nobody could find the play button. Faced with this nightmare, the Bank of Japan did what desperate central banks do. They slashed interest rates to zero, then below zero. When that didn't restart growth, they introduced yield curve control, a policy that essentially forced long-term bond yields to stay near the floor regardless of market conditions. For decades, Japanese government bonds paid virtually nothing. Now imagine you're managing money for a Japanese pension fund or insurance company. You've got billions to invest, but your home country's bonds offer zero return. You're left with 2 options: accept earning nothing on your capital or look elsewhere. Overwhelmingly, Japanese investors chose option 2. They went shopping abroad. This launched a multi-decade global spending spree. Japan became the largest foreign holder of United States treasuries. Japanese institutions poured money into American mortgage-backed securities, corporate debt, and equities. They became the world's biggest net creditor, essentially functioning as an ATM for global markets. But this wasn't charity. The math simply made sense. Here's how the trade worked. An investor would borrow yen at near zero interest rates, convert those yen into dollars, then purchase United States treasuries yielding 4% or more. After accounting for hedging costs, they'd pocket the difference. This became known as the yen carry trade. And it wasn't limited to bonds. When your borrowing costs approach zero, suddenly everything looks attractive: technology stocks, real estate, emerging market debt. If an asset offered any yield above zero, Japanese capital flooded in. At its peak, estimates put the yen carry trade in the trillions of dollars. For years, it was among the largest sources of global liquidity. Markets worldwide were essentially running on Japanese financing, and almost nobody realized it. The entire structure rested on one critical assumption: Japanese yields would stay near zero forever. That assumption shattered in 2024. The Bank of Japan ended yield curve control. They raised interest rates for the first time in 17 years. Then they raised them again. Markets reacted violently. Following the second rate increase, the S&P 500 dropped 6%. Japan's Nikkei index plunged over 12% in a single session, its worst daily decline since 1987. The message was unmistakable. The era of free Japanese money was ending. When Japanese yields rise, 2 things happen simultaneously. First, borrowing in yen becomes more expensive. Second, hedging currency exposure costs more. Suddenly, that 4% treasury yield doesn't look nearly as attractive after you subtract higher borrowing and hedging costs. The trade that worked flawlessly for decades stops making sense. And when the math changes, the capital flows reverse. Money that flowed out of Japan for 30 years is now returning home. This process, called repatriation, represents one of the most significant shifts in global finance today. The cheapest source of worldwide liquidity isn't cheap anymore, and that changes everything. For decades, Japan wasn't just another buyer of American debt. They were the most reliable, price-insensitive buyer of long-term treasuries. This matters because those long-term yields aren't controlled by the Federal Reserve. The Fed sets short-term rates, the overnight borrowing cost for banks. But 10-year, 20-year, and 30-year treasury yields? Those are determined by supply and demand in the open market. Right now, everyone's watching the wrong indicator. Financial media obsesses over Federal Reserve meetings, parsing every word from the chairman like it's a cryptic prophecy. But the Fed only controls one end of the yield curve. The long end, where most real-world borrowing costs are anchored, operates independently. It responds to who's buying and who's selling. This is where Japan's shift becomes critical. The United States runs trillion-dollar deficits annually. To finance these deficits, the Treasury must constantly issue new debt. Someone has to absorb that debt. For the past 3 decades, Japan was a cornerstone of that absorption capacity. They bought consistently in massive quantities without obsessing over price. But what happens when one of your largest, most dependable buyers steps back? Supply stays constant, demand drops, and in bond markets, reduced demand means one thing: yields rise to attract new buyers. This creates a scenario most investors haven't considered. The Fed could cut short-term rates aggressively, yet long-term yields might barely move or even increase. That's not a malfunction. That's supply and demand doing exactly what economic theory predicts. And when long-term yields stay elevated despite Fed cuts, the implications spread far beyond the bond market itself. Stock valuations get compressed when this happens. Analysts building financial models use long-term Treasury yields as their discount rate for future cash flows. Higher yields mean future earnings are worth less today. Companies can report solid quarterly results, beat earnings estimates, and still see their stock prices stagnate or decline. The fundamentals haven't changed. What's changed is the price investors are willing to pay for those fundamentals. Markets become unstable even when corporate performance looks healthy. This disconnect confuses casual observers who see strong earnings but falling stock prices. They assume something must be broken. Nothing's broken. The valuation framework itself has shifted beneath their feet. Mortgage rates tell the same story. They're anchored to the 10-year Treasury yield, not the Federal Reserve's overnight rate. When the Fed cuts rates but the 10-year yield stays elevated, mortgage rates remain stubbornly high. Home buyers waiting for 3% mortgages to return will keep waiting. Housing affordability stays constrained. Refinancing activity slows to a crawl. Real estate transactions decline. The entire housing market operates in slow motion, not because of Fed policy, but because global demand for American debt has fundamentally changed. Corporate credit markets face identical pressure. Remember 2020 and 2021? Companies issued debt like it was free money. Investment-grade firms refinanced existing obligations at historically low rates. Private equity funds borrowed aggressively to finance acquisitions. Startups raised convertible notes with minimal dilution. Cheap capital fueled deal activity, inflated valuations, and accelerated growth across every sector. Credit was the bloodstream keeping the corporate body alive and thriving. But when borrowing costs stay elevated despite Fed cuts, that bloodstream constricts. Companies delay expansion plans, acquisitions get shelved. Refinancing becomes expensive rather than opportunistic. Risk appetite evaporates. Growth slows. Capital markets tighten. The economic engine doesn't roar. It hums along in second gear, unable to accelerate no matter how much the Fed tries to help. This is the core issue nobody's discussing. For 3 decades, America operated on the receiving end of the world's largest carry trade. Japanese capital flowed into American assets automatically, predictably, massively. That structural tailwind is reversing. The trade that supported American asset prices, suppressed borrowing costs, and provided endless liquidity is unwinding in real time. Traditional financial media ignores this because it's not clickable. It doesn't generate outrage or excitement. Nobody's going to retweet a thread about cross-currency carry trade dynamics and Japanese institutional reallocation strategies. That requires patience, nuance, and attention spans longer than 15 seconds. Instead, headlines scream about inflation prints, AI valuations, and whatever dramatic statement a politician made yesterday. Those topics are visible, loud, and emotionally charged. They trend. They get engagement. So the narrative gets simplified to absurdity. Fed cuts rates, everything gets better. Markets go up, problem solved. Except that's not how any of this works. Rate cuts don't automatically ease financial conditions when the structural buyers of your debt are stepping back. Liquidity isn't a light switch the Fed controls with interest rate decisions. It's a complex global system built on decades of capital flows, institutional behavior, and risk-adjusted return calculations. The lie being sold is that monetary policy fixes everything. One rate cut, and suddenly housing becomes affordable again. Another cut and stocks resume their upward march. Keep cutting and prosperity returns. But what happens when your largest foreign creditor reassesses the math? When the institution that absorbed trillions of dollars in American debt decides the returns no longer justify the risk, liquidity tightens. Not because the Fed wants it to, not because inflation is too high or unemployment is too low, because the invisible architecture supporting global markets has shifted. Liquidity is oxygen for financial markets. When it contracts, everything feels harder. Borrowing costs stay elevated. Asset valuations compress. Economic activity slows. And most people never understand why because they're watching the wrong indicators entirely. This matters more than almost anything else happening in markets right now. Yet it receives virtually no mainstream coverage. AI valuations dominate headlines. Inflation data moves markets intraday. Political drama generates endless commentary. Meanwhile, the structural foundation beneath all asset prices is quietly transforming, and almost nobody notices. The threats that actually reshape markets aren't the loud ones. Those get priced in immediately. Inflation concerns, already reflected in forward curves. Tech bubble fears, debated endlessly and adjusted for continuously. The real dangers are boring, technical, and easy to ignore. They hide in plain sight, dismissed as too complex or too niche to matter, until suddenly they're the only thing that matters. Japan's policy shift isn't a crisis. It's a slow-motion structural change that will reshape global capital flows for years. American assets won't collapse overnight. Markets won't crash because Japanese institutions are repatriating capital. But the invisible support that propped up valuations, suppressed yields, and provided endless liquidity is weakening. And when that support fades, everything built on top of it has to adjust. You're watching the end of a 3-decade cycle. The longest carry trade in modern financial history is unwinding. Most investors don't know it exists. Most analysts aren't tracking it. Most headlines won't mention it. But its effects will ripple through every corner of global markets for years to come. Higher borrowing costs despite Fed cuts, compressed valuations despite solid earnings, tighter financial conditions despite accommodative policy, and almost nobody will connect the dots back to Tokyo. The real risks in markets aren't found on CNBC. They don't trend on financial Twitter. They exist in the technical plumbing that nobody wants to understand because it requires actual thought. Japan's reversal is that risk. It's already happening. The effects are already visible if you know where to look, and your portfolio probably isn't positioned for what comes next.